Hello and welcome to Simplicity in Stocks. In these videos, we will dive into the important foundations of investing. Investing can be hard if you are really trying to understand it deeply, but it doesn't have to be. You can put yourself ahead of most investors if you know the important points of analyzing companies and the stock market. By learning these basic but important points of how to invest in the share market, you would be doing your bank account a big favor. Warren Buffett, the most successful stock market investor in the world, has said that investors need to know only two topics to understand investing: how to value a company and how to think about stock prices. The key to success in the stock market is in the details of these two topics. In this video, we will cover the top 10 terms you need to know as a serious investor in the stock market. Do keep in mind that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There's no opinion or view on any stock covered herein. 1. Intrinsic value. The intrinsic value of a company is its theoretical true value. It is different from the company's market capitalization in the stock market. The intrinsic value of a company can be thought of as the value of all its growth in profits over the course of its life. While it's possible to calculate this, the result is not a single objective number. This is because the calculation has assumptions built into it. Two people can calculate different intrinsic values of the same company using the same data, just by using different assumptions about the company's future. Thus, intrinsic value is always an estimate. The most important thing to understand about intrinsic value is that it acts as a guide for making buy and sell decisions. If the stock price is below its intrinsic value, it could potentially be a buy. The opposite is also true. If the stock price is above the intrinsic value, it could potentially be a sell. 2. Margin of safety. Warren Buffett calls margin of safety the three most important words in investing. When the stock price is less than its intrinsic value, then we say there is a margin of safety in the stock. If the stock price is rupees 80 and the intrinsic value is rupees 100, then we say that there is a margin of safety in the stock for a potential buyer. There is no margin of safety if the stock price is higher than the intrinsic value. Margin of safety is one of the basic concepts of value investing. 3. Valuations. A stock can be considered expensive or cheap based on how investors are valuing it in the market. This valuation is different from the stock's intrinsic value. What's the simplest way to gauge how expensive or cheap a stock is? The answer is in the valuation ratios. The lower the ratio, the cheaper is a stock. The two most common valuation ratios are the price to earnings ratio (PE) and the price to book ratio (PB). The PE ratio is calculated by dividing the stock price by its earnings per share (EPS). The other way to calculate it is by dividing the market cap by the net profit. The PE ratio is used for valuing asset-light companies or companies with steadily growing earnings. The PB ratio is calculated by dividing the stock price by its book value per share. The other way to calculate it is by dividing the market cap by the total book value. The book value or net worth of a company is its total assets subtracted by its total liabilities. The PB ratio is used for valuing asset-heavy companies or companies with flat or falling earnings. It's also used for valuing banks and financial companies. 4. Margins. A company's profitability is usually a good indicator of its quality. The stock market likes high profit margin stocks. These are usually companies that have strong brands or have some kind of competitive advantage within its industry. Now, if a company has low margins, it doesn't necessarily mean that it's a bad quality company. It's just that it's susceptible to losses if suddenly sales were to fall or expenses were to rise. The two margins that you should know about are 1. Operating margin, that is the operating profit divided by sales, and the net margin, that is the net profit divided by sales. 5. Return ratios. The return ratios are the main determinants of business quality. The two return ratios that you should know about are the return on equity (ROE) and the return on capital employed (ROCE). For financial stocks, a return on assets (ROA) is also important. The return on equity (ROE) is one of the most important financial ratios. It tells us how well the company has used its shareholders' money to make profits. The ROE is calculated by dividing the current year's net profit by the average shareholders' equity for that period. A good way to start your search for high quality stocks is to screen for high return ratios. For example, a screen like high ROE stocks in India. Return on capital employed (ROCE) measures a company's efficiency in using its capital to generate profits. A high ROCE indicates that a company is efficient in generating profits using the capital that it has invested in the business. These are also called high return stocks. The ROCE is calculated by dividing the company's operating profit by the capital employed. The operating profit in this case is the earnings before interest and taxes, EBIT. This can be found or calculated from the company's income statement. The capital employed is the sum of the equity capital and the total debt of the company. 6. Debt to equity. Companies often borrow funds to grow the business. There's nothing wrong about this, but things can get unpleasant if the debt levels get too high. The leverage that a company uses is an indicator of the risk in owning the stock. High debt stocks in India have a reputation for being very volatile on the Indian stock market. During market corrections, these stocks tend to fall the most. On the other hand, debt-free stocks are considered safe by most investors and are usually in demand. The debt-to-equity ratio is a powerful tool in your investing strategy. Make good use of it. This ratio is calculated by dividing a company's total debt, both short-term and long-term, by its equity, that is, its net worth. Considering only those companies with a debt-to-equity ratio lower than 1, ideally lower than 0.5, is a good way to filter out risky stocks. 7. Working capital. This is the amount of funds a company needs to meet all its financial obligations within 1 year, that is the next 12 months. The working capital is the difference between the current assets and current liabilities of a company at any given point in time. It's a good measure of a company's liquidity, that is its ability to pay the bills as they come due, as well as its short-term financial health. The current assets of a company include the cash in the bank, short-term liquid investments, the accounts receivables, the inventory, and any prepaid expenses. The current liabilities of a company include the accounts payable, short-term debt due within a year, and any dividends or taxes coming due within the year. The current assets and current liabilities can be found on the company's balance sheet. The current liabilities are usually settled by current assets, so a company should have a sufficient buffer between its current assets and current liabilities to avoid any liquidity issues. However, the opposite situation, that is an extremely high working capital, is also not always a good thing. It could be a sign that a company has too much cash in the bank that is not being used productively. It could also be a sign of inventory piling up and going unsold. 8. Cash flow. If there is one thing that you should absolutely never ignore about a company, it's the cash flow. The statement of cash flows can be found in the company's annual report. It tells you how much cash is flowing in and out of the business and how it's being used. The cash flow from operations measures the cash generated by the business. The cash flow from financing measures the cash raised or repaid via debt and equity. The cash flow from investing measures the cash to be invested or disinvested in the business. Always remember that a company's profits can be manipulated by aggressive accounting, but its cash in the bank cannot. Always pay attention to how a business is using its cash. It can be a decisive factor in your investing strategy. 9. Management. At the end of the day, a business is only as good as the people who run it. A good management can help turn around the fortunes of a bad or average business. More importantly, a bad management can destroy even a good business. Pay close attention to the big decisions taken by the management. Ask the following questions about the management. Are they investing the cash wisely? Are they taking decisions that are in the interests of shareholders? Are they taking steps to grow revenues and improve margins? What is their dividend policy? Are they transparent about the reasons for their actions? It's never a good idea to be invested in a stock with good fundamentals if the quality of the management is suspect. The risk is just too great in such cases. 10. Dividends. Companies paying out a slice of their earnings to shareholders typically have a good record of strong profits. This gives an incentive to the company to maintain dividend payments in the future. These stocks are also considered to be a good buffer for one's portfolio during times of market volatility. High dividend payout stocks also have the potential for value appreciation. Thus, they can bring a dual benefit in the long run. These stocks provide a good way to beat inflation. The dividend payout ratio is the total dividend paid out by the company in a year divided by its net profit for that year. The market likes a payout that is high and stable or a payout that is growing. Companies paying a high amount of profit as a dividend are called high dividend stocks, which is something that you can screen for. Finally, don't ignore the dividend yield. The dividend yield is the dividend per share divided by the stock price. A high dividend yield could be an indicator that a stock is undervalued. High dividend yield stocks are perceived to be safer than low dividend yield stocks. If the market falls, these stocks will offer a higher yield to investors due to the higher dividend payouts. Well, there you go. We believe that understanding these 10 points clearly and deeply will put you ahead of most retail investors in the market. Until next time, happy investing.